The S&P 500 just rallied 127 points on news that strikes against Iran were cancelled. And that move might be the most dangerous green candle you will see this month. There is one danger zone and one hidden opportunity right now. I'll show you both before this video ends. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow morning before the institutional algo ramp. Here is the session bias for the S&P 500 heading into tomorrow's open, range-bound with a bullish drift that is actively failing on internals. We are not trending. We are not reversing cleanly. We are trapped between 72.23 support and 73.53 resistance with a pivot sitting at 73.09. Write this number down. If we break and close below 72.23 on the daily chart today or tomorrow, the entire bullish structure from the March lows resets completely. That is your invalidation line in the sand. Where is the herd right now? Retail is 67% long after today's pop. Institutional flow data shows SPY saw $340 million in outflows yesterday. That means the big money used this headline to reduce size while you were watching the green numbers print. That divergence alone tells you everything about who is really driving this market. Let me walk you down the timeframes because this is where the truth hides. Start on the monthly chart. The monthly trend remains strong buy, and I don't argue with that timeframe. Price is above all major moving averages on the monthly. MA20, MA60, MA200 are all stacked bullishly. But here is what most traders miss. The monthly candle for June is still forming, and we are sitting 127 points above last month's close on extremely thin summer volume. The weekly chart also says strong buy, and again, I respect that. The weekly MA200 is sitting at 6,855, which is miles away, so the structural bull market is intact. But the daily trend is neutral. That is your first warning. When weekly says strong buy but daily says neutral, you are in a bull market that has paused to catch its breath, or to trap everyone leaning too hard in one direction. The 5H trend is also neutral. And the 1H trend just flipped to strong buy after today's rally. But that is the most deceptive signal in this entire setup because it only captures the last 5 hours of price action. Look at the moving averages on the daily. Current price is 7,394. MA20 is 74.23. MA50 is 72.76. MA100 is 70.96. MA200 is 68.55. Do you see the problem? Price is trading below its own 20-day moving average on the daily chart despite being up 127 points today. That is technically bearish price structure relative to short-term momentum. The 20-day MA at 74.23 is now acting as overhead resistance. The 50-day at 72.76 is the first real support below us. We are sandwiched between 2 major moving averages with no clear allegiance to either. Now let me show you the divergence that changes everything. The 4H MACD reading is 49.370, which is positive, but look at the slope of the histogram. It is flattening while price made a higher high. Today, that is a textbook negative divergence on the 4H timeframe. Buyers are exhausted. The 1H MACD is also showing weakening momentum on the latest bar. And the CCI on the daily is sitting at negative 116. That is deeply oversold on the daily despite the 127-point rally. How can price be up 2% and still have a daily CCI in oversold territory? Because the rally was concentrated in less than 6 hours on a single news headline with no follow-through volume. The ADX on the daily is 27.7. which tells you we have a trend present, but it is weakening from the 35-plus readings we saw 2 weeks ago. Let me give you the exact support and resistance levels that matter. Support 1 is 7,223. That is the first line of defense from the June lows. Support 2 is 7,179. That is the 4H demand zone that has held twice in the last 9 trading days. Support 3 is 7,092. Which coincides with the daily 100 MA. Resistance 1 is 7,353, which is the level we failed to hold above 3 times in the last week. Resistance 2 is 7,440, the high from June 9th. Resistance 3 is 7,484, the all-time high rejection zone from last month. The pivot point is 7,309. And watch how price behaves around this level tomorrow. Above 73.09 with conviction, the bulls have a path to 73.53. Below 73.09 on the first hour, we are testing 72.23. Here is what most traders miss about this entire structure. The 200-week moving average is sitting at 68.55, and we are 539 points above it. That is not a brick wall, that is an anchor. The further price climbs above the 200-week, the more gravity exists for a mean reversion trade. But the market never just falls because it is too high. It falls because a trigger arrives. Keep watching because the next signal changes everything. Let me connect the news directly to price action because headlines don't matter. How the market reacts to them is all that matters. Yesterday's news that Trump said strikes against Iran were cancelled triggered a classic risk-on squeeze. Oil dropped 4% on that headline within 2 hours. The VIX collapsed from 16.2 to 14.8. And the S&P 500 ripped 127 point higher. But here is the problem. The strikes were never priced in to begin with. Geopolitical premium in the S&P 500 was basically zero going into that headline. So when the threat was removed, you didn't get a relief rally from a discount. You got a short squeeze on a narrative that was never real. That is why the breadth is so thin. Only 4 sectors participated in today's rally: technology, communication services, consumer discretionary, and financials. Utilities, healthcare, consumer staples, energy, industrials, materials, and real estate all underperformed or closed flat. That is not a healthy rally. That is a liquidity grab in the most crowded names. Now let me build the narrative web. The S&P 500 is moving tick for tick with Nasdaq futures, which are being driven by 3 stocks: Nvidia, Apple, and Microsoft. Those 3 names accounted for 62% of today's index move. The other 497 stocks contributed 38%. Meanwhile, the dollar index is sitting at 104.8. which is neutral for equities. Real yields on the 10-year tips are at 2.12%, up 3 basis points today, which should pressure growth stocks, but they rallied anyway because the Iran headline overwhelmed the yield signal temporarily. That temporary overlap is the crack in the armor. When real yields rise and stocks rise together, one of them is wrong within 48 hours. The 1 to 2 week directional lean is bearish on any move above 7,353 that fails to hold. I expect we test 72.23 within the next 5 trading sessions unless the Fed delivers a surprise dovish pivot. And the exact event that invalidates my lean is a daily close above 74.40 on rising volume with breadth above 70% of stocks trading above their 20-day moving average. Do you think the S&P 500 breaks above 74.84 this week or rejects from 73.53 again? Comment breakout or rejection right now. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching because I'm about to give you 3 distinct ways to trade this setup depending on your risk tolerance and account size. Every single level I give you is exact. Every stop loss has a reason. Every target has a technical justification. Strategy 1, the sniper, conservative. This is for traders who wait for the highest probability setup and accept lower frequency for higher reward. The trigger condition is a retest of 7,223 support on the daily time frame with a 4H candle closing above that level and the RSI on the 4H showing a bullish divergence, meaning price makes a higher low but RSI makes a lower low. That divergence is not present yet, so you are waiting for it to develop. Your entry is at 72.30 on a 4H bullish rejection candle with a wick below 72.23 and a close above 72.25. Stop loss goes 4 points below the 4H demand zone at 71.75. That gives you 55 points of risk. Target 1 is 7,353 for a 123-point move and a risk-reward ratio of approximately 1 to 2.2. Target 2 is 7,440 for a 210-point move and a risk-reward of 1 to 3.8. What voids this setup entirely? A daily close below 72.23. If that happens, the entire structure breaks and you wait for 70.92, the sniper, conservative, entry. 72.30 on 4H bullish rejection candle stop loss. 71.75 take profit 1. 73.53 take profit 2. 74.40 risk, air reward. 1:2.2R to 1:3.8R invalidation. Daily close below 72.23 strategy 2. The active trader, standard. This is for traders who want to engage with the current range and take mean reversion trades with a higher frequency. The setup is fading the move to the upper end of the range. Wait for price to reach 73.53 resistance on the 1H timeframe. Your entry condition is a 1H candle closing below 7,345 after touching 7,353 or higher. This is a rejection entry. You are betting that resistance holds. Stop loss goes 25 points above the resistance at 73.78. That gives you 33 points of risk on the short side. Target 1 is there. Pivot at 73.09 for a 44-point move and a risk-reward of 1 to 1.3. Target 2 is the lower support at 72.23 for a 130-point move and a risk-reward of 1 to 3.9. Once Target 1 is hit at 7,309, you trail your stop to break even and let Target 2 run. The trailing rule is simple. After price reaches 73.09, move stop to 73.15, then lock in profit every 50 points. Type your S&P 500 range for tomorrow in the comments now. Let's see who's aligned with the technicals to the active trader, standard, entry. 1H close below 7,345 after touching 73.53 stop loss. 73.78 take profit 1. 73.09 take profit 2. 72.23 risk, air reward. 1:1.3R to 1:3.9R invalidation. 4H close above 73.60 strategy 3. The aggressor, high risk. This is for experienced traders who can manage fast moves and accept that this trade could lose 50% of the allocated capital within hours. You are counter trend chasing a momentum failure. The trigger is a false breakout above 73.53. You need to see price spike above 7,353, ideally to 7,360 or 7,370, on low volume, then reverse back below 73.53 within the same 1H candle. Entry is at 73.40 on the 5-minute chart as soon as price confirms the false breakout with a red candle closing below 73.45. Stop loss is tight at 7,370. Which is only 30 points above entry. Target 1 is the pivot at 73.09 for a 31-point move and a risk-reward of approximately 1 to 1. Target 2 is 72.23 for a 117-point move and a risk-reward of 1 to 3.9. Explicit warning. Only for those who can lose small and manage risk aggressively. This trade has a win rate below 40% but a massive average win when it works. If the market does not give you the false breakout within the first 2 hours of the session, stand aside the aggressor, high risk, entry. 73.40 on 5M red close below 7,345 after false spike above 73.53 stop loss. 73.70 take profit 1. 73.09 take profit 2. 72.23 risk, reward. 1:1R to 1:3.9R invalidation. No false breakout within first 2 hours of session ever risk more than 1 to 2% of your total account value per trade on any of these setups. The sniper strategy offers the highest probability but requires patience. The aggressor strategy is for demo accounts or tiny sizing until you have proven your execution. No positions through tomorrow's Fed speak or the monthly options expiry on Friday. Stops are non-negotiable on every single trade I just gave you. This is how you survive to trade the next big move. Let me summarize the single most critical level for tomorrow's session, 72.23. Above that level, the bulls can build a case for a retest of 7,353. Below that level on a daily close, everything changes, and we target 7,092 within 7 days. Tomorrow's focus is the Fed speakers at 10 a.m. and 2 p.m. Eastern, specifically whether Powell hints at September cuts or pushes back against market pricing of 75 basis points by year-end. If you want the full breakdown on how Bitcoin is shadowing the S&P 500 divergence and why the Nasdaq could decouple tomorrow, that video is live now. Tap the end screen. Smash like if this gave you a clear plan with exact levels you can actually trade. Subscribe, hit the bell, and I will see you in the next one.